Chart patterns are the foundational building blocks of technical analysis. They repeat themselves in the market time and time again and are easy to spot for experienced investors. To make it easier for you to follow the patterns, we have created an algorithm for finding them on Finscreener. We have selected the 5 most influential chart patterns that you can easily find on our website following this video. The first one is Head and Shoulders chart pattern. Head and Shoulders is a chart pattern in which a large peak has a slightly smaller peak on either side of it. Traders look at Head and Shoulders patterns to predict a bullish to bearish reversal. Typically, the first and third peak will be smaller than the second, but they will all fall back to the same level of support, otherwise known as the neckline. Once the third peak has fallen back to the level of support, it is likely that it will break out into a bearish downtrend. The second one is Inverse Head and Shoulders. The inverse Head and Shoulders pattern begins with a downtrend. This is the extended move down that eventually leads to exhaustion and a reversal higher as sellers exit and buyers step up. That downtrend is met by minor support, which forms the first shoulder. As the market begins to move higher, it bounces off of strong resistance and the downtrend resumes. This resistance level forms what is called the neckline. After the market makes a lower low, it finds strong support which forms the head of the pattern. The market finds resistance at the neckline once more, which forms the second shoulder. At this point, the inverse Head and Shoulders is taking shape. The third one is Double Top. A double top is another pattern that traders use to highlight trend reversals. Typically, an asset's price will experience a peak before retracing back to a level of support. It will then climb up once more before reversing back more permanently against the prevailing trend. The fourth, Double Bottom. Unfortunately, if you are seeing this message, the algorithm haven't found a neatest pattern on the market, but a double bottom chart pattern indicates a period of selling, causing an asset's price to drop below a level of support. It will then rise to a level of resistance before dropping again. Finally, the trend will reverse and begin an upward motion as the market becomes more bullish. A double bottom is a bullish reversal pattern because it signifies the end of a downtrend and a shift towards an uptrend. And the last one is Triangle Top, or Descending Triangle. The descending triangle is a bearish formation that usually forms during a downtrend as a continuation pattern. There are instances when descending triangles form as reversal patterns at the end of an uptrend, but they are typically continuation patterns. Regardless of where they form, descending triangles are bearish patterns that indicate distribution. The classic descending triangle pattern forms with a trend line that is sloping and a flat or a horizontal support line. The pattern emerges as price bounces off the support level at least twice. The descending triangle chart pattern occurs after the end of a retracement to a downtrend. You can find all these and many other patterns on our website and analyze them by yourself. Finscreener, your world of finance.